show us that there is big trouble ahead. Now, that's probably not a big surprise. We're seeing lots of signs that show us there's lots of trouble ahead. But as we're watching the world start to break down this decentralization that I talk about, we're watching it play by play, and I want to try to explain to you what's going on. Now, I think it's apparent that a lot of what we're seeing in the markets today, the stock market's dropping and real estate dropping, the economy faltering, all these things are being driven by central bank policy. So you can see that as central banks expand their balance sheet, the market's too good, the economy does good because there's more money in the system. The problem, as we've been documenting for years now, is the Fed is stuck. The central banks are all stuck, all the central banks of the world, because they've been printing so much money for 50 years that now we have way too much money out there. It's basically a Ponzi scheme. They have to continue to put more money in the system for it to continue to grow. But the problem is that they're trying to taper because there's too much debt. So the debt to GDP is way too high. And now all of this money in the system is causing massive amounts of inflation. That means people like you and I can't afford gas and we can't afford food. Now in emerging markets, it's even worse. And so the Fed in the United States and other central banks around the world are all finding themselves in the same situation where they've all printed too much money, there's way too much inflation, but there's also too much debt, and they're stuck between the proverbial rock and a hard place. Now, in the United States, the dollar, being the reserve asset of the world, is sort of like what we call the cleanest shirt in a pile of dirty laundry. And so while it's not good by any means, it's certainly better than what Japan is facing with 250, 260% debt to GDP. It's certainly better than what China is facing with 350% debt to GDP. And when you factor in all the other problems China has with their demographics and so forth, it's a big problem. Europe's having a massive problem as well, too much debt. They've been negative interest rates and they're trying to raise them, but as soon as Europe's trying to raise their rates, Europe's fallen off of a cliff, and now they've come up with some new plan, this fragmentation plan I'm not going to get into. But all of the world is in the same situation, and the Fed, the United States Central Bank, is bent on raising rates. They are committed to raising rates. They are committed to bringing inflation back down to 2%, and everybody's wondering when they will pivot or start lowering rates again, but they are committed to continue raising rates until inflation is down. The problem is if the Fed, the dollar, continues to raise rates, the rest of the world also needs to do the same thing, because if they don't, their economies and their currencies will get crushed under the strength of the dollar. So what do? Well, Europe is trying to come up with some sort of a plan where maybe they can weaken and strengthen, and this fragmentation plan, maybe they'll try to figure that out. And in China, they're saying, well, we can't do that, and we're just going to have to continue easing. And that's going to be a big problem. So let's jump in and take a look at this story that I have right here. So China prepares a $220 billion stimulus with a tsunami of bond sales. So China, they're in bad situation. I know a lot of people are expecting China to take over the world. We should all learn Mandarin because they're going to take over the world and all these things. But China is in a very, very bad situation for a number of things. I'm not going to cover them all, but one, as I've already hit on, their debt to GDP, the amount of debt they have is insane. They have no energy. Without energy, you have nothing. They have to import over 85% of their energy. They're not able to grow much food in China. They don't have enough fresh water, and the water they have has been completely contaminated. And they've had disastrous policies, namely for 40 years, a one-child policy. So their demographics are horrible. So they're projected to lose half of their population over the next 25 years, just aging out. So what happens when you increase the money supply and you increase the population? Well, you get lots of growth. What happens when you decrease the money supply and you decrease the population? Well, it's the opposite of growth. You can figure that out. So China's in a bad situation, but they just can't wait. They can't strengthen like the U.S. does, and they said, for enough, we're going to have to pivot, and we're going to have to start stimulating again. So let's look at this. So China, which remains painfully limited in how it can kickstart its slowing economy, way more limited than what the Fed is preparing for a massive fiscal stimulus in the form of a tidal wave of local government bond sales. China, which is the world's second largest economy, faltering, especially after China's President Xi Jinping made clear weeks ago that the COVID zero isn't going anywhere. So China has committed to zero COVID. They've committed to that, which means they're committed to lock down the entire country if they can't get COVID down to zero. The problem is when you do that, then there's no production. There's no production of goods and services and food and things like that. And so it's really, really hit them hard on top of all of the problems that they have. Their own policies are backfiring. And it says here that the People's Bank of China is going to cut the key interest rates, and they are set for round 2 of stimulation, an infrastructure splurge. So we can see 220 billion. Now, what's important to understand, it says this is the first time the issuance has ever been fast-tracked in this way. It's the first time we've ever seen it fast-tracked in this way. And why is that important? Well, they've never done this before. They've never had to push it through before, and that underscores the growing concerns in Beijing over the dire state of the world's second largest economy. So what this shows us is that this is emergency. This is emergency measures. Now, today we throw around the word emergency all the time, but this is a real emergency. That's why they are pushing this through. I'm going to show you the problem that this causes, but we can see that there are some good effects. If you're an investor, if you're a trader, you can look at these things. And so commodities have caught a solid bid on the expectations that China will once again emerge as a major buying force as it prepares to build a whole new batch of ghost cities. So China is in bad shape. Their debt, I already named them all. I'm not going to do that. But what China did in order to get themselves out of this very poor rural farming country is they started moving people from the farms into the cities to build all these cities. And they started basically printing unlimited amounts of money to build what it says here, ghost cities, meaning China has roads and bridges that go to nowhere. They have entire cities with skyscrapers and condos with nobody living in them. And so they were able to show their GDP growth, their gross domestic product growth, because look, we've built all this. And so they're buying all these construction materials from all around the world. They're buying lumber, they're buying concrete, they're buying all these things, they're building all these things. Everybody's working. They're coming out of poverty on the farms. Now they have jobs. Now they're making money. It's the greatest turnaround in the world we've ever seen, except for they just built a bunch of stuff that nobody wants. And they didn't really increase anything other than what they did here by creating ghost cities that they won't even have the population to live in. Now, what's the problem with this? Well, like I said, the problem is that while the rest of the world is needing to tighten, now they are loosening, which is only going to exaggerate the problem. This is the same problem that we're seeing other countries like Sri Lanka, like Peru, like Ecuador, like Lebanon. I could go on. These countries are all dropping like flies because they've had to continue to print more money, stimulate their economies. But the problem is, eventually fails. Now we can see with some numbers here exactly what this looks like. This is Steve Hankey's inflation dashboard. So you can see it on the screen right here. Let me zoom it in a little bit here, maybe. Here we go. And you can see the amount of inflation. Of course, Zimbabwe has been the poster child of inflation. It's up 426% annually. So that means you're losing all your money about every quarter. That's not good. Sri Lanka is up 117%. Turkey's 108%. Venezuela's 90%. Cuba's 85%. You get the idea. Why are all these countries having such massive inflation? Because of debasement. When you debase your currency, when you print more, you inflate the money supply, it buys less and less goods and services. That's why all of these countries are seeing 50, 60, 70, 80, 100, 400% inflation. And this is the exact same thing that's going to happen to China as they continue to do this. It's not good, and you don't come back from this. And this looks like it could be one of the final death nails to China. All these countries are failing. All their currencies are failing, and bigger dominoes will fall. Could China be next? I was thinking it'd probably be Japan. Maybe it's going to be Europe, the southern states of Europe. I don't know. China's in the running. But what do you think? Leave me a comment. Which country do you think is going to fail next? One of the big ones will fail next. If you haven't already, click like on this video so more people see it, and then hit that subscribe button and the bell notification so you know when I put new videos out. That's what I got for today. All right, to your success. I'm out.